Welcome back to the Deep Dive, the show where we cut through the noise to get to the core knowledge of the world's most fascinating companies.
Hey there.
For years, the story around NVIDIA, ticker NVDA, was all tangled up in this AI hype cycle. It was this soaring valuation built on, futuristic promises.
Right. It was all about what could happen.
Exactly. But what happens when the hype doesn't just show up? What happens when it becomes this undeniable, concrete financial reality that seems to defy the fundamental laws of business?
And that's our challenge today, isn't it? We're looking at a company that has entered a period of, you have to call it hypergrowth. It's so massive, so intense, that it really challenges this idea of the law of large numbers.
Explain that for a second.
Sure. It's just the basic principle that, growth has to slow down as a company's revenue base gets bigger. It's just harder to double $1 billion than $1 million.
So when you're already making tens of billions a quarter, doubling, or even just keeping 60% growth going, it just shouldn't be possible.
It shouldn't be. And yet, here we are, NVIDIA's doing it.
So our mission today is to go deep. We've got these comprehensive financial research reports that cover two really distinct pivotal periods, Q3 fiscal year 2025 and Q3 fiscal year 2026.
Yep.
We're not just going to look at the final numbers. We want to track, almost quarter by quarter, how this company completely transformed its business model, how it managed these unprecedented operational challenges, and, critically, how the CEO, Jensen Huang, plans to sustain this pace.
With things like the new Blackwell architecture and this whole concept of sovereign AI.
Exactly.
And our sources are, they're incredibly detailed. We're talking 10 years of historical metrics, deep operational insights, and these really forward-looking strategic assessments on everything from supply chain constraints to future competition.
So we're not just chasing momentum here.
No, absolutely not. We're here to rigorously figure out if this is just a historically great stock that got bid up, or if it's a truly great business with an unassailable economic moat and a real margin of safety for the years ahead.
And before we dive in, we have to give our crucial reminder. All the analysis we're about to present is based on publicly available financial sources.
Yeah.
It is strictly for educational purposes.
Yes. We're here to synthesize knowledge. We are not offering investment advice.
You absolutely have to conduct your own independent due diligence.
Precisely. And look, analyzing a company is only one part of the equation. You have to understand the broader market context, right? The overall temperature of the economy.
That's a great point.
So if you want a non-emotional, data-driven tool to track that total market froth, we'd really encourage you to search for and download the iOS app Buffett Indicator from the Apple App Store.
A very useful tool.
It is. And for those of you who want to join our full deep dive into these more advanced topics or get access to more strategic content, you're always welcome to join our Deep Value Club membership.
Okay, let's unpack this growth story. I want to start with just the sheer velocity of change. If you look at the financials separated by just 1 year, 4 quarters, the acceleration is, it's breathtaking.
It really is.
Let's start with Q3 fiscal year 2025. At the time, everyone thought that was the absolute peak.
That's right. That quarter, which wrapped up late in 2024, it just set all these historical records. Revenue hit $35.1 billion. And that wasn't, just a little bit of growth. That was a phenomenal 94% year-over-year increase.
Yeah.
And it was driven almost entirely by the massive, massive demand for their Hopper H100 GPU platform. That was really the moment the AI supercycle went mainstream.
Okay, so 94% growth. Now, fast forward just 4 quarters to Q3 fiscal year 2026. This is where that law of large numbers we talked about was supposed to slam on the brakes instead.
Instead, it actually accelerated. In Q3 of 26, revenue soared even further to an astounding $57 billion.
$57 billion in a single quarter.
In 1 quarter. Now, that's a 62% year-over-year jump, which is remarkable enough on that scale. But the number that really tells the story is the 22% sequential growth.
Meaning from the quarter just before it.
Right. It means their growth actually sped up, even coming off the enormous $46.7 billion base of Q2. To get your head around the scale of this, that single $57 billion quarter is more than the company's entire annual revenue from just fiscal year 2023.
Let's pause on that. The 22% sequential jump.
Yeah.
That kind of growth off a $40+ billion base isn't just a financial marvel, it's an operational one.
Oh, absolutely.
You're talking about managing logistics, securing components, manufacturing, and then shipping an additional $10 billion worth of product in 3 months. What does that kind of velocity tell you about their supply chain?
It says they are absolute masterclass operators. I mean, for a while there, NVIDIA wasn't constrained by demand at all. They could sell everything they could make. The problem was manufacturing capacity at the very bleeding edge.
Right.
Specifically, the constraints were around CoWoS packaging.
And just remind us what that is.
It stands for chip on wafer on substrate. It's basically the really advanced way they stack and connect multiple chips together, like the main GPU and the super fast memory right next to it. That and the HBM3E high bandwidth memory itself were the bottlenecks.
So these are the technical choke points of the entire AI era.
They are. So the fact that sequential growth jumped from 16% in Q2 to 25% in Q3, that is the clearest signal you can get that those bottlenecks were finally resolving.
They could open the floodgates.
They could crank the spigots wide open, and they did it just as they were starting the transition to their next generation platform, Blackwell. It just confirms that the whole story has shifted from a company with potential to a company with, frankly, undisputed and overwhelming dominance.
And that dominance is really concentrated in one place now, the data center segment. This is the whole story.
It is the business, absolutely. The
Yeah.
data center segment isn't just the biggest part of NVIDIA, it is NVIDIA now. If you go back to Q3 of 25, data center revenue was over $30 billion, which was about 85% of the total. And within that, the compute GPU sales were $27.6 billion. That was up 132% year over year.
And by Q3 of 26, that concentration just got even more intense.
It did. Data center revenues shot up to $51.2 billion. It now makes up nearly 90% of the company's total revenue.
90%.
The insight here is really crucial. NVIDIA is no longer a gaming company that just happens to have a cool AI side business. It is, as the research reports put it, the sovereign foundry of the AI age.
What does that mean, sovereign foundry?
It means they manufacture the essential foundational infrastructure that every nation, every major company, every researcher needs if they want to participate in this revolution. It's like they're the only ones selling the shovels in a global gold rush.
So they have the scale. But this is where it usually gets tricky. Maintaining profitability while you're scaling complex hardware this fast is usually where the wheels come off. So let's talk about margins and operating leverage. Because somehow they are managing this with the financial efficiency you'd expect from a pure software company.
This, to me, is the most stunning financial metric of all. Despite transitioning to the new Blackwell systems, which are more complex, use more expensive HBM3E memory, inherently higher cost materials, NVIDIA somehow managed to maintain and even expand their gross margins.
Okay, so what were the numbers?
They were at about 72% GAAP gross margin in Q3 of 25, and that actually increased to 73.4% in Q3 of 26.
Expanding margins while you're ramping up a brand new higher cost product line. I mean, that just screams pricing power, doesn't it?
It's phenomenal pricing power. It means they're not just passing along those higher memory and packaging costs, they're capturing even more value on top of it. But the operating leverage, that's an even better story.
Okay, define operating leverage for us.
It's just how fast your operating income grows compared to your revenue. If your profits grow faster than your sales, you have great leverage.
And in Q3 of 26,
well, while revenue grew by that 22% sequentially, their operating expenses, OPEX, R&D, sales, admin costs, grew by only 8%.
wow.
This massive difference is pure leverage. It drove their operating income to a staggering $36 billion. That translates to an operating margin of over 63%.
63%. For a company selling physical goods, that's unheard of.
It's the characteristic footprint of a software monopoly. It's where your fixed costs, like all the money they spent on R&D for CUDA over the years, are spread across this exponentially larger base of paying customers.
So it's the closest thing you can get to a software as a service financial model, but in the hardware space.
Indeed. It just proves that the vast majority of their cost structure is fixed. So every single extra dollar of revenue they bring in, minus the direct cost of the chip, drops almost straight to the bottom line.
We can't let the data center story completely overshadow everything else, though. Because while they're now, just 10% of revenue, the non-DC segments are actually really important. They're these high-profit cash cows that are strategically vital.
That is a great point. I mean, take gaming. It's their legacy business, right?
Yeah.
But it's still delivered a really robust $4.3 billion in Q3 of 26.
Which is a 30% year-over-year increase. So that's still a healthy business.
It's a huge business. $4.3 billion is a number most tech companies would kill for. And for NVIDIA, it's just the side gig.
Right.
And then you have automotive. It's still the smallest segment, 406 million, but it surged 123% year over year. Their drive and Orin systems are becoming the standard brain for advanced autonomous driving and AI cockpits.
So you have these two other businesses, one that generates billions and another that's growing in the triple digits. And they're basically funding the core R&D.
Exactly. They are funding that core $15 billion annual run rate R&D budget that's needed to maintain the data center lead. It gives them a financial resilience that their competitors just can't match.
Okay, let's talk about the moat. Because if the hardware eventually becomes a commodity, this whole high-flying growth story has to end.
Right.
And CEO Jensen Huang has been very clear about this strategic transition from just being a component vendor, just selling a graphics card, to being a platform provider. What does that really mean, and where does the real lock-in lie?
The moat is really layered, and you're right, the hardware performance is only the most visible layer. Yes, they have staggering market share, something like 92% in discrete GPUs and over 80% in AI accelerators. But the real fortress that's built out of software.
We are, of course, talking about CUDA.
CUDA. It stands for Compute Unified Device Architecture. And you have to remember, they developed this way back in 2006. This was years before the current AI boom was even a whisper.
So it's the programming platform, the API.
Yeah.
It's kind of like the operating system for their GPUs.
That's a perfect way to put it. It's what makes their hardware intelligent and programmable.
And why is that so powerful? Why does it create such high switching costs?
Because it became the industry standard. There are millions of developers around the world, the people who are actually writing the code that drives the AI revolution, and they are all trained on CUDA. Every major machine learning framework, whether it's TensorFlow or PyTorch, is optimized for it.
So if you're a company and you've spent years and millions of dollars developing your AI models on that stack.
Right. Migrating that whole code base, retraining all your developers, re-optimizing your models for a competitor's chip, it is a massive, massive undertaking. It's expensive and it's risky.
So it's like having a proprietary operating system that runs 90% of the world's most critical applications, even if a competitor comes out with a cheaper or maybe a slightly faster physical box.
The cost of rewriting your entire software foundation makes that competitor's offering functionally irrelevant for most customers.
It's the definition of a walled garden.
It is, but it's a garden that's so fruitful that everyone is willingly moving inside. The whole investment thesis really relies on the fact that this lock-in creates inertia, and that insulates NVIDIA from competitors who are only focused on hardware.
And they're just making that moat deeper with the next generation. Blackwell. The reports call this an architectural revolution, not just a speed bump. What's the key difference here?
The key shift is that Blackwell, especially the GB200 platform, is all about rack-scale computing.
Rack scale.
Yeah. They're moving away from selling you individual chips and towards selling you these fully integrated supercomputing systems. Take the GB200 NVL72 system. It connects 72 Blackwell GPUs and 36 of their Grace CPUs into one massive cohesive unit that basically functions as a single computer.
So instead of customers having to piece together thousands of components themselves, NVIDIA is just delivering a pre-integrated, pre-optimized AI factory.
Precisely. They're controlling more of the total system value, and they're removing all that integration complexity for the customer.
Yeah.
And it plays right into their supply chain advantages, especially with that CoS packaging we talked about, which is essential to stitch all those components together for maximum performance.
Let's focus on one crucial metric the reports highlight. Blackwell offers a 10 times throughput per megawatt improvement for inference compared to Hopper.
Yes.
Why has this per megawatt metric suddenly become more important than just raw clock speed or FLOPS?
Because it's the critical operational necessity of our time. Data centers are running up against a really severe physical constraint. Power.
Right.
Hyperscalers are building these centers so large that they're literally hitting the capacity limits of the local electrical grid. And inside the data centers, the racks themselves are constrained by power delivery and, crucially, heat dissipation.
So they're either running out of electricity or they're generating so much heat they can't cool the building efficiently.
Exactly. Running a huge AI cluster demands megawatts of power, and all that power creates an enormous amount of heat. So if a new chip gives you 10 times the performance for the exact same amount of electricity, it solves two huge problems at once.
It lowers your electric bill.
Dramatically. And it defers the need for these incredibly expensive and complex liquid cooling systems or trying to secure these multi-year contracts with utility companies. Blackwell basically solves the power crisis for hyperscalers, and that strategic advantage is massive.
That makes the hardware so much stickier than just being the fastest. It's about total cost of ownership and the ability to scale your operations.
And that leads to the final element of the moat, their control over the supply chain. I mean, NVIDIA's scale gives them this unparalleled logistical power.
We mentioned the CoWoS packaging capacity was tight.
It is the absolute bottleneck in the entire AI supply chain. And because NVIDIA is this high-volume leader in both gaming and data center, their scale gives them capacity assurance. They get preferential treatment at the leading foundries, specifically TSMC.
So when these cutting-edge manufacturing processes are constrained globally, only a handful of customers like Apple and NVIDIA get guaranteed access at the front of the line.
Which means any competitor is not only chasing a performance benchmark that's constantly moving, but they're also stuck in line behind NVIDIA just for the ability to physically produce their chips.
It's a huge barrier to entry.
It is. And it's all sustained by their aggressive R&D spend, which is running at about $15 billion a year. They're setting the pace of innovation, ensuring they have this multi-year lead. That sustained investment is the ultimate testament to their business quality.
All right, let's shift to how they're diversifying their demand. Because if you're an investor, the biggest fear over the last couple of years was customer concentration.
Right, that the whole business relied on the spending of the Magnificent Seven hyperscalers.
Exactly. And NVIDIA is actively cultivating these two new pillars of demand to deal with this. The first one is called sovereign AI.
Sovereign AI is a really strategic, almost geopolitical concept. Nations all over the globe have suddenly recognized that AI infrastructure is now the same thing as national security and economic independence.
They don't want their culturally specific language models, their critical medical data, or their defense systems trained and housed on public cloud infrastructure owned by, foreign companies.
Exactly. So this is demand that's driven not by corporate ad revenue, but by government budgets and strategic policy. It's a totally different, much steadier class of customer.
And the reports have an example.
Yeah, the Riken deployment in Japan. Riken is this major scientific research institute. They focus on climate science, industrial research, and they announced a huge deployment built on the GB200 platform. We're talking 1,600 Blackwell GPUs. It's a massive, multi-year strategic investment.
So the significance here is that it reduces that concentration risk, and this government-driven demand is way less cyclical than corporate spending.
It introduces a lot of resilience. Government spending on critical infrastructure tends to be really sticky. It's driven by multi-year political cycles, not quarterly interest rate changes or, a temporary cut in an ad budget.
Okay, so that's pillar number one. The second pillar is the compounding nature of AI itself, this virtuous cycle, driven by the explosion of inference.
This is the long-term exponential growth story. The virtuous cycle idea is that advanced AI models are being used to create even more advanced AI models, which then require progressively more compute power.
And we're shifting from the training phase, the big upfront cost to build the models, to the inference phase.
The operational consumption phase. And inference is where the growth really compounds, because every single time a user makes a query, every time an AI takes an action, it burns compute time.
Exponentially so, right?
Yes. We're moving beyond simple, chat GPT question-answer models. We're moving into what's called agentic AI.
Autonomous software agents.
Right. Agents that can reason, plan, execute multi-step workflows. Think of an AI that could manage your entire supply chain or design a new protein from scratch. These agents are complex, they're resource-intensive, and they just reinforce the stickiness of the CUDA ecosystem.
And the numbers are huge.
The industry estimates that for every dollar you spend on initial training, you'll probably generate 3 to 5 times that in revenue from inference over the model's life.
Yeah.
And we are just at the beginning of that inference explosion.
We have to turn to the risks now. We have to. Starting with geopolitical decoupling, the China story, this was a massive headwind they had to navigate.
It was decisive. After the U.S. put in all those export controls on high-end chips, NVIDIA was forced to create these compliant stripped-down chips like the H20 to try and keep some market access.
And what did the Q326 report say about how that's going?
It revealed that these compliant chips have seen zero share in the Chinese market in recent quarters.
Zero. And that's largely due to rising domestic competition, especially from Huawei's Ascend chips, and just all the regulatory ambiguity making big purchases too risky for Chinese companies.
So the implication is clear. NVIDIA has effectively lost what was historically 20 to 25% of its entire data center market.
Which should have absolutely cratered their growth figures.
It should have. But here's the critical silver lining. This is the strongest possible de-risking event you could imagine. NVIDIA achieved 66% year-over-year data center growth despite completely losing that massive China market.
Wow, so the demand from the U.S., from Europe, from allied nations, it's so voracious that it completely absorbed the loss of a multi-billion-dollar market and still drove phenomenal growth on top.
That is the core takeaway for risk management. Future U.S. sanctions can't really hurt a revenue stream that's already gone to zero. The stock is, in a sense, now de-risked from future geopolitical hits related to China.
Right.
It just proves the extraordinary, uncapped appetite for AI infrastructure everywhere else.
Okay, let's talk about the other two big risks, cyclicality and competition. First, the air pocket theory.
The air pocket theory comes from looking at historical infrastructure booms. The risk is basically that once the hyperscalers are 50 billion a quarter customers finish building their first massive training clusters, they might just pause.
Take a breath.
Right. Pause capital expenditures for a year or two to digest that new capacity. And that would create a temporary but very severe demand cliff for NVIDIA before that inference explosion we talked about fully ramps up to compensate. It's a very real cyclical threat.
And the second, more existential threat, the customers becoming the competitors, the ASIC threat.
This is the big long-term strategic threat. You've got companies like Google with their TPU, Amazon with Inferentia and Trainium, Microsoft with Maya. They're all designing custom chips, basics, application-specific integrated circuits.
Chips that are optimized for one thing and one thing only.
Yeah.
Their specific AI workloads.
Exactly. And over the long term, if their workloads stabilize, these custom chips can offer superior performance per dollar compared to buying a general-purpose NVIDIA GPU.
It's the ultimate paradox of success, right? You innovate so well that you motivate your biggest clients to spend billions trying to build their own alternative. What's NVIDIA's counter-argument?
It's really twofold. First, as we've said, the CUE software moat makes shifting to a new hardware architecture really complex and costly. But second, and this is probably more important, algorithmic volatility.
Meaning the AI field is still changing really fast.
Incredibly fast. An ASIC that's perfectly optimized today for, say, a transformer architecture might become functionally obsolete if the whole industry pivots to a fundamentally new model architecture next year. The GPU, because it's general purpose and programmable through CUA, is the safe, flexible bet in a field that's defined by radical, rapid change.
So the GPU is the Swiss Army knife, while the ASIC is the highly specialized but inflexible scalpel.
That's a perfect analogy. If AI algorithms stabilize for a long time, the ASIC probably wins on efficiency. But if they keep evolving rapidly, the flexible GPU wins. NVIDIA is betting everything on continued evolution.
And finally, we just have to reiterate that supply concentration risk, the Taiwan situation.
Yeah, this is a low probability but extremely high impact risk. NVIDIA is fabless. They design the chips, but they don't manufacture them. They rely almost entirely on TSMC for that advanced wafer fabrication and, critically, the CoWoS packaging.
So any geopolitical conflict in the Taiwan Strait?
It represents an existential threat to their ability to deliver product. Now, TSMC is trying to diversify its footprint, but the vast majority of leading-edge capacity is still concentrated in Taiwan. It's a crucial geopolitical risk that any investor just has to keep an eye on.
Okay. We've established this is an extraordinary company, operationally and strategically. Now we have to subject it to the rigorous lens of the classic value investor.
Right.
We're using the 10-year metrics table from the research. This is where we figure out if the quality actually justifies the price.
And this section really reveals the ultimate dichotomy of NVIDIA. It's a growth company priced for hypergrowth, which means it instantly fails the strict conservative filters of classic deep value investing.
Let's run through the failures quickly, but explain why they fail. PE ratio, the classic measure. It should ideally be below 15. Where's NVIDIA?
Based on the latest trailing 12 months earnings, the PE is around 50. And historically, its 10-year median PE is already high, hovering over 50. The company has basically never traded anywhere near that strict PE of 15 or less. So by that one rule, it's a decisive fail. It is not a cheap stock.
Okay, what about price to book, PB? That should be below 1.5.
PB is currently sitting around 35. I mean, trying to value NVIDIA with price to book is kind of pointless.
Why is that?
It's an asset-light company. Its value is tied up in intellectual property, in the CUDA software, in its future earnings power, not in physical factories or equipment on the balance sheet. But still, a number like 35 is clearly way outside the traditional range. The failure of these metrics just tells us this isn't a stock you're going to find by screening for low asset ratios.
Okay, now for the fun part, the quality metrics, the things that are undeniable. What does NVIDIA pass comfortably?
It passes virtually every single operational quality check with flying colors. The first measure of quality is gross margin. The requirement is typically above 40%. NVIDIA's has been consistently over 50% for a decade, and thanks to all that pricing power, has now soared to about 75%.
That's 75%. That's world-class profitability. That's what you see from software giants.
It is. It's a measure of how proprietary and defensible their product is. They're capturing the vast majority of the value they create.
Okay, what about efficiency, how they use capital?
So we look at return on equity, ROE, and return on invested capital, ROIC. The benchmark for quality is usually around 15% for ROE, 12% for ROIC.
And NVIDIA's performance.
Their 10-year average ROE is about 26%. And thanks to this recent AI earnings surge, their trailing 12 months, ROE has skyrocketed to a staggering 69%.
Wow.
It just tells you that management is exceptionally efficient at turning shareholder equity into profit. And for ROIC, they consistently deploy capital at very high rates of return, well above that 12% benchmark. When a company can reinvest its earnings at such high rates, it just creates this enormous compounding machine.
And finally, the cash machine itself, free cash flow.
This is the lifeblood. The rule is it has to be positive every year with a healthy margin. NVIDIA has generated positive free cash flow every single year for the past decade. The margin has recently hit 44%. It's an incredible cash-generating engine. And that excess cash is what allows for the aggressive R&D and the massive buybacks we're about to discuss.
So the conclusion for the traditionalist is, great company, but the market has always known it's a great company, so you almost always have to pay a premium.
Exactly.
Which brings us to the modern valuation method. The discounted cash flow analysis, the DCF, which tries to quantify the value of all that future growth.
Right. The DCF is essential here because it looks past historical ratios and focuses on the present value of future cash. First, we need a discount rate, the WACC weighted average cost of capital. The reports calculated this at 9.14%.
So what does that 9.14% signify?
It's the minimum required rate of return. It's a hurdle rate. We have to project all the future cash flows and then discount them back to today's dollars by at least that much per year to find their present value.
Okay, so let's run 3 scenarios to test the sensitivity. Let's start with the most pessimistic one. Scenario 1, the no growth case.
This assumes that from their current massive free cash flow run rate, about $60 billion a year, that FCF just stays flat forever. No more AI growth, no new markets, just $60 billion a year. Discounting that back gives you an intrinsic value of about $243 per share.
Wait, hold on a second. If the stock was trading around $186 at the time of the report and the no growth intrinsic value was $243, that means the stock was actually trading about 23% below its value in the most pessimistic scenario possible.
That is the astonishing finding. It suggests that the market isn't pricing in zero growth, but that the sheer volume of cash they're generating right now already covers a huge portion of the market cap. In other words, the company has grown so profitable so fast that its current earnings power provides this large inherent margin of safety.
And that completely changes the expensive stock narrative.
Okay, what about scenario 2, conservative growth? Let's assume FCF grows at a modest 5% a year. Right, roughly in line with long-term GDP. A very conservative assumption. In that scenario, the calculated intrinsic value jumps to about $347 per share.
So if you demand a comfortable 30% margin of safety on that, your buy price is around $243. Given the market price was $186, this conservative 5% growth scenario suggests the stock was trading with a healthy margin of safety.
This is the key takeaway from the DCF. If NVIDIA can sustain even very modest mid-single-digit growth over the long term, the stock, based on its current earnings, appears to be undervalued by this framework.
And what about the last one, scenario 3? Nominal growth, say 10% a year for the next decade.
If they can sustain 10% growth, which seems highly achievable, the intrinsic value shoots up to about $493 per share. In that scenario, the stock is trading at roughly half its intrinsic value. It really suggests the market isn't pricing in those crazy 60% growth rates, but rather a moderate, sustained growth path.
So to sum up the valuation part, it looks expensive on the classic metrics, but the DCF analysis suggests the sheer volume of cash flow means the price is defensible and maybe even offers a margin of safety against pretty moderate growth expectations.
And the research reports we're looking at reached a similar conclusion. They assigned a 12-month target price of $235, which was derived from a probability-weighted mix of different cases, showing a lot of confidence in the durability of this growth.
The quality of a company is always tied to its leadership. And in NVIDIA's case, you have Jensen Huang, CEO since 1993, over 30 years. That kind of continuity is almost unheard of in tech.
And that continuity isn't just a footnote, it is the fundamental reason for their moat. Only a leader with that kind of long-term vision could have invested billions into something like GPU computing for AI, starting with CU Day back in 2006, years before it showed any real return. I mean, that's arguably the single greatest strategic decision in modern semiconductor history.
And his interests are totally aligned with shareholders. He still owns about 3.5% of the company, a stake worth tens of billions, which just dwarfs his compensation package. He's a true owner-operator.
That alignment is key. It ensures his focus is on long-term value creation, not just short-term, quarterly results. Now, we do have to acknowledge the blemish, the 2022 SEC settlement over the crypto mining revenue disclosures.
Right.
But the reports do indicate that transparency and governance have improved a lot since then, which shows management is responsive to accountability.
Okay, let's look at capital allocation, which has shifted pretty dramatically. Historically, they paid a tiny token dividend.
Yeah, the annual dividend is 16 cents a share. It's a negligible yield, but it always signaled a core principle. They preferred to reinvest every single dollar back into that high-return R&D to fuel future growth.
But now the sheer volume of cash being generated, that $60 billion a year run rate, means they can do both.
They can reinvest massively and return capital to shareholders. And the big capital allocation story now is the massive, aggressive share repurchase program.
This is management's way of telling the market, we think our stock is cheap.
Shouting it from the rooftops. In August of 2023, the board authorized a huge $25 billion buyback. Then, in August 2025, they authorized an additional jaw-dropping $60 billion program with no expiration date.
So that's $85 billion in total authorized buybacks. That's an enormous figure. It provides this huge structural support for earnings per share.
It's so significant because it's so different from their past. The total cumulative buybacks over the previous decade were only about $15 billion. This new magnitude just shows management's absolute conviction that the stock, even with its high valuation multiples, represents a good long-term value based on its intrinsic value.
And institutional support is still strong, which confirms this confidence.
Yeah, institutional ownership is very high. About 69% is held by major players like Vanguard and BlackRock. It just indicates general satisfaction with management and their performance.
We have covered a lot of ground today. Let's try to summarize the essential takeaways from this deep dive into the NVIDIA machine.
First, I think the business transformation is absolute. NVIDIA is now a data center powerhouse. It's generating nearly 90% of its revenue from that infrastructure, and it's achieving this hyperscale growth even after effectively losing the entire China market.
Second, their moat is getting deeper, and it's centered less on just having the fastest chip and more on the stickiness of that decade-old CUDA software ecosystem, which is now reinforced by the operational efficiency of the Blackwell platform's 10 times throughput per megawatt.
And third, their future growth is being diversified into these really resilient markets, especially sovereign AI. That's driven by national security and strategic policy, and it significantly reduces that customer concentration risk we were worried about.
And finally, valuation-wise. While the stock fails all the strict classic value investor tests because of the high multiples, the DCF analysis suggests that the sheer volume of cash being generated, combined with the high probability of even moderate, sustained growth of 5 to 10% a year, more than justifies the current price. It confirms its status as a truly great company.
Which brings us to the ultimate provocative thought for you to consider as you digest all of this. NVIDIA has successfully navigated two massive industry transitions in its history, from PC graphics to gaming, and then from gaming to the AI data center.
So the question is this: can the company, relying on its software moat and this rapid architectural evolution, successfully fend off its largest customers, the hyperscalers like Google and Amazon, who are simultaneously becoming its largest competitors by developing their own custom silicon, those ASICs?
It is the highest stakes game in the entire tech world. How long can NVIDIA keep its lead when its best clients are actively trying to disintermediate them? That tension, the race between CUDA's flexibility and the ASIC's optimization, is the long-term risk that will define the next decade for this business.
Thank you for joining us for this deep dive. And remember, this content is for educational purposes only. It does not constitute investment advice. We always encourage you to conduct your own independent research.
And if you do want to track the total market temperature and get a data-driven perspective on market cycles, welcome to search for and download the iOS app Buffett Indicator from the Apple App Store. For listeners who are interested in more in-depth content just like this, please welcome to join our Deep Value Club membership. We will see you on the next deep dive.